Ladies and gentlemen, over my lifetime studying markets, debt cycles, currencies, and the rise and fall of empires, I've learned one critical lesson. Most people lose money not because they choose the wrong assets, but because they misunderstand how the system actually works. Today, I want to talk to you about gold and silver and why people who believe they own protection in these assets may still end up losing. Let me be clear from the start. Gold and silver are not bad assets. In fact, throughout history, they have been among the most reliable stores of value during times of monetary disorder. They have survived every fiat currency experiment ever created. But owning gold or silver does not automatically make you safe. How you own it, why you own it, and when you panic are what determine whether it protects you or destroys your wealth. We are living in a classic late debt cycle. Governments around the world are burdened with unsustainable debt levels. When debts grow faster than income, there are only a few ways out: austerity, defaults, restructuring, or printing money. History shows us that printing money is almost always the path chosen because it is politically easier. And when money is printed, currency is devalued. That is the environment where gold and silver shine. Gold and silver have been trusted stores of value for thousands of years, surviving the collapse of empires, the failure of currencies, and the repeated mistakes of governments. Yet despite this long history, most people who invest in these metals still end up disappointed or even financially damaged. The reason is not that gold and silver fail, but that investors fail to understand the system they are operating within. Protection does not come from the metal itself. It comes from understanding how money, debt, and power interact during times of economic stress. We are currently living in a world shaped by a latest-stage debt cycle. Governments, corporations, and individuals have accumulated enormous levels of debt relative to income. Historically, when debt reaches these extremes, it cannot be repaid in real terms. Policymakers are forced to choose between painful defaults or less visible solutions, like currency devaluation. Almost every time they choose devaluation because it spreads the pain quietly across society. This is the environment in which gold and silver perform their historical role as stores of value. However, simply knowing this fact is not enough to ensure protection. Most investors approach gold and silver with a surface level understanding. They hear that inflation is rising, that currencies are being printed, or that a crisis is coming, and they rush in expecting quick gains. This mindset treats gold and silver as speculative trades rather than strategic holdings. When prices rise sharply, confidence grows, and people believe they have made the right decision. But markets never move in straight lines. Corrections are inevitable, and when they arrive, those without a deep understanding of why they own these metals begin to doubt themselves. Fear replaces conviction, and protection turns into panic selling. Another major misunderstanding lies in the belief that all forms of gold ownership offer the same security. In reality, there is a critical difference between owning an asset outside the system and owning a claim within it. Many investors rely on paper instruments such as ETFs, futures contracts, leveraged products, thinking they are equivalent to physical ownership. In normal times, these instruments function smoothly. But in periods of severe stress, when trust in institutions weakens, the rules can change. Access can be limited, settlements can be altered, and liquidity can disappear. Those who believed they were protected discovered that their ownership was conditional. Understanding the system also means recognizing that governments and central banks do not operate in a vacuum. Their primary goal is to maintain stability and control. When faced with systemic threats, they will act in ways that favor the system's survival, not individual investors. History shows capital controls, changes in taxation, restrictions on movement of money, and sudden policy shifts. Gold and silver can help protect wealth in these environments, but only if investors understand that policy risk is as real as market risk. The people who truly benefit from gold and silver are those who approach them with clarity and patience. Understand that these metals are not designed to outperform every asset in every year. Instead, they are meant to preserve purchasing power over long periods, particularly when currencies lose credibility. This long-term perspective allows investors to hold through volatility without emotional reactions. They are not surprised by pullbacks because they expect them. Their confidence comes from understanding cycles, not from watching daily price movements. Ultimately, the difference between losing and being protected comes down to education and mindset. Gold and silver reward those who think in terms of systems, history, and probabilities. They punish those who chase headlines, ignore structure, and react emotionally. When you truly understand how the financial system works, how debt grows, how money is created, and how power responds under pressure, you stop expecting gold and silver to make you rich quickly. Instead, you allow them to quietly do what they have always done: protect wealth. The system around them changes. One of the most consistent reasons investors lose money in gold and silver is not market manipulation, bad timing by others, or even unexpected events. It is emotional decision making. Human psychology plays a far greater role in investment outcomes than most people are willing to admit. Fear and greed dominate behavior, especially during periods of uncertainty, and precious metals tend to amplify these emotions because they are closely tied to crisis narratives, inflation fears, and systemic collapse stories. Most people enter gold and silver at the wrong time. They buy when prices are already rising sharply and media coverage is intense. Headlines warn of currency collapse, financial instability, or a coming crisis, and emotions take over. At that moment, buying feels safe because everyone else is doing it. Prices are going up, experts are being quoted, and the fear of missing out becomes overwhelming. This is not strategic investing, it is emotional reaction. Historically, these moments of widespread enthusiasm often occur closer to market tops than bottoms. When prices inevitably correct, psychology shifts dramatically. Gold and silver are volatile assets in the short term. Even during long-term bull markets, they experience sharp pullbacks that can last weeks, months, or even years. For investors who bought without conviction or understanding, these pullbacks feel like confirmation that they made a mistake. Instead of seeing volatility as normal behavior, they interpret it as danger. Fear replaces confidence, and the desire to stop the pain leads to selling at the worst possible time. This emotional cycle repeats itself over and over. People buy high, driven by fear of inflation or crisis, and sell low, driven by fear of loss. The irony is that gold and silver often perform best after periods when sentiment is most negative. When investors give up, when the metals are declared dead or irrelevant, the conditions for long-term gains quietly begin to form. Those who are emotionally exhausted exit the market just as disciplined investors begin AC accumulating. Another emotional trap is overconfidence during rallies. When gold and silver prices rise rapidly, many investors begin to believe they finally understand the market. They increase their exposure, take on leverage, or concentrate too heavily in one asset. This false sense of certainty is dangerous. Markets have a way of humbling participants who believe outcomes are guaranteed. When reversals occur, losses are magnified and emotional stress intensifies, often leading to irrational decisions that permanently damage wealth. Media and social influence further amplify emotional behavior. Online commentary, social media, and sensational predictions create an environment where extreme outcomes seem certain. Predictions of $5,000 gold or $100 silver become emotionally persuasive, not because they are impossible, but because they are repeated constantly. Investors stop thinking in probabilities and start thinking in absolutes. When reality unfolds more slowly or differently than expected, disappointment turns into panic and positions are abandoned prematurely. Emotional investing also prevents investors from sticking to a clear plan. Without a predefined strategy, decisions are made reactively. There is no framework for when to buy more, when to hold, or when to rebalance. Every price move feels urgent and personal. In contrast, disciplined investors understand their reasons for owning gold and silver. They expect volatility. They size their positions appropriately, and they are mentally prepared to hold through uncomfortable periods. The reality is that markets are designed to test emotional endurance. Gold and silver in particular punish impatience. They reward those who remain calm when others are fearful and cautious when others are euphoric. The majority lose not because gold and silver fail as assets, but because they fail to control their emotions. Those who master their behavior, develop conviction through understanding, and resist the pull of fear and greed, position themselves on the winning side of history. One of the most dangerous misunderstandings in the gold and silver market is the belief that all forms of ownership provide the same level of safety. In reality, there is a critical difference between owning a tangible asset outside the financial system and owning a paper claim that exists entirely within it. This distinction becomes especially important during periods of financial stress when trust in institutions weakens and the rules of the game begin to change. Paper, gold, and silver, such as exchange-rated funds, futures contracts, options, and other derivative products, are built on layers of promises. Under normal conditions, these instruments function efficiently. They offer convenience, liquidity, and ease of trading. For many investors, they feel no different from owning physical metal. Prices move, accounts update, and transactions settle smoothly. This creates a false sense of security, leading people to believe they are protected from systemic risk, when in fact they are still deeply embedded within it. The problem arises when the system itself comes under pressure. In moments of crisis, liquidity evaporates, counterparty risk increases, and institutions prioritize their own survival. History shows that when markets face extreme stress, access to assets can be restricted, settlement rules can be altered, and contractual obligations can be reinterpreted. Investors who thought they owned gold or silver may discover that what they actually owned was a claim subject to the stability and goodwill of multiple intermediaries. Gold and silver are often sought as protection against systemic failure, currency debasement, loss of confidence in fiat money. But paper instruments depend on the very system investors are trying to hedge against. If a financial institution fails, if clearing mechanisms freeze, or if governments intervene to maintain stability, paper claims can become vulnerable. This is not a theoretical risk. It has happened repeatedly throughout history, different forms from suspended gold convertibility to frozen accounts and capital controls. Another overlooked risk is rehypothecation and leverage. Many paper, gold, and silver products are structured in ways that allow the same underlying metal to support multiple claims. This works as long as not everyone demands delivery at the same time. But in a true crisis, confidence disappears quickly. If too many investors attempt to convert paper claims into physical metals simultaneously, the system can strain or fail. Those at the end of the line may receive cash settlements instead of metal, often at unfavorable prices. Ownership outside the system carries a different set of considerations. Physical gold and silver, when held directly, are not someone else's liability. They do not depend on a counterparty's promise to exist. This independence is what gives them their historical role as money during times of crisis. However, even physical ownership requires understanding. Storage, security, jurisdiction, and accessibility all matter. Without planning, physical assets can become illiquid or difficult to access when they are needed most. Many investors fall into the trap of convenience. Paper assets are easy to buy and sell with a click, and they fit neatly into modern portfolios. Physical ownership requires more effort, more responsibility, more foresight. But convenience often comes at the cost of resilience. When systems are stable, convenience feels like safety. When systems are stressed, resilience is what matters. Understanding the difference between paper and real ownership is not about rejecting modern financial tools entirely. It is about aligning the form of ownership with the purpose of the asset. If gold and silver are intended as insurance against systemic risk, then owning them entirely within the system undermines that purpose. Those who fail to recognize this mismatch may believe they are protected only to discover their protection was conditional. Ultimately, the people who avoid losses are those who ask deeper questions. They look beyond price charts and consider structure, counterparty risk, and historical precedent. They recognize that in times of stability, paper and physical may appear identical, but in times of crisis, the difference can be everything. Gold and silver fulfill their true role only when ownership aligns with understanding and understanding aligns with reality. One of the most important principles investors must understand about gold and silver is that they are not designed to be vehicles for short-term speculation. They are not growth assets in the traditional sense, and they are not meant to produce income or rapid returns. Gold and silver function best as insurance protection against the long-term erosion of purchasing power, monetary instability, and systemic risk. When investors misunderstand this role, they set themselves up for disappointment and poor decision-making. Speculators approach gold and silver with expectations shaped by stories of dramatic price explosions. They focus predictions, targets, and timelines, believing that owning precious metals means inevitable and imminent profits. This mindset creates unrealistic expectations. When prices fail to move as expected or when they move sideways for extended periods, frustration builds. That frustration often leads to abandonment of positions at precisely the wrong time. Insurance, by its nature, does not feel rewarding most of the time, yet it proves its value when it is truly needed. Gold and silver have historically preserved wealth rather than multiplied it rapidly over long periods. They tend to maintain purchasing power while currencies decline. This means they often lag during strong economic expansions and equity bull markets. Investors who compare gold's performance to stocks during boom times may conclude that it is unnecessary or inefficient. But this comparison misses the point. Gold and silver are meant to perform differently from risk assets. Their value emerges during periods of stress, inflation, or loss of confidence in financial systems. Treating gold and silver as insurance also means sizing positions appropriately. Over-allocating creates pressure to expect high returns, which in turn increases emotional stress during periods of underperformance. When too much wealth is concentrated in one asset, every price movement feels personal. In contrast, balanced allocation allows investors to hold gold and silver calmly without the constant urge to react. The metals can then serve their intended purpose without dominating decision-making. Speculation also introduces leverage, which is particularly dangerous in precious metals markets. Leveraged positions magnify both gains and losses, but more importantly, they remove time from the equation. Insurance requires time. It is designed to be held through cycles, not traded daily. Leverage forces liquidation during volatility, often before the long-term thesis can play out. Many investors who are right about gold and silver still lose money because they are leveraged at the wrong time. Another misunderstanding is expecting gold and silver to respond immediately to monetary expansion. Money printing does not always translate into instant price increases. There can be long delays as liquidity moves through financial systems. During these periods, metals may appear stagnant, leading speculators to believe the thesis is wrong. In reality, the underlying conditions are building quietly. Those who understand gold and silver as insurance remain patient, knowing that the payoff is protection, not constant excitement. Insurance also requires discipline. You do not cancel insurance simply because nothing bad has happened recently, yet investors routinely abandon gold and silver during periods of stability just before risk begins to rise. Again, this behavior reflects a misunderstanding of purpose. Gold and silver are held not because disaster is guaranteed, but because uncertainty is unavoidable. Viewing gold and silver as insurance changes behavior. Price fluctuations become less emotionally charged. Short-term noise fades in importance. Decisions are based on long-term risk management rather than short-term prediction. Investors who adopt this mindset are far less likely to panic, overtrade, or chase unrealistic outcomes. In the end, gold and silver reward those who respect their role. They protect quietly, often invisibly, while other assets appear more exciting. But when monetary confidence weakens and paper promises are questioned, that quiet protection becomes invaluable. Those who treat precious metals as insurance rather than speculation are the ones who remain steady while others scramble, preserving not just wealth, but peace of mind. One of the most powerful lessons from history is that no single asset provides complete protection in every environment. Markets move in cycles, economies shift, and risks change form over time. This is why diversification has always been the most reliable defense against wealth destruction. Relying too heavily on any one asset, even gold or silver, creates vulnerability rather than security. True resilience comes from balance, not concentration. Gold and silver play an important role in protecting against currency devaluation and systemic risk. But they are not immune to volatility, policy changes, or shifts in investor sentiment. Periods exist where precious metals underperform for years, sometimes decades, while other assets thrive. Investors who place all their faith in a single narrative expose themselves to long stretches of disappointment. When patience runs out, poor decisions follow. Diversification prevents this emotional fatigue by spreading risk across assets that respond differently to changing conditions. A well-diversified portfolio acknowledges uncertainty. It accepts that no one can consistently predict which asset will perform best next. Instead of betting on a single outcome, diversification prepares for multiple possibilities. Growth assets such as equities benefit from economic expansion and innovation. Defensive assets like gold protect against inflation and monetary instability. Cash provides liquidity and flexibility. Real assets, bonds, and alternative investments each play a role. The goal is not maximum return, but survivability across cycles. Many investors misunderstand diversification as simply owning many assets. True diversification is about owning assets that behave differently under stress. Markets crash. Correlations often rise, and assets that seem diversified suddenly move together. This is why understanding the underlying drivers of each asset is crucial. Gold and silver, for example, tend to respond to currency weakness and loss of confidence, not necessarily economic growth. Their value lies in being different, not in being dominant. Overconcentration often stems from strong convictions. When investors become convinced that a particular outcome is inevitable, they overweight assets tied to that belief. While conviction can be valuable, overconfidence is dangerous. History is filled with examples of narratives that seemed obvious at the time but unfolded differently. Diversification acts as a safeguard against being wrong, even when confidence is high. Another benefit of diversification is behavioral. It reduces emotional pressure. When one asset underperforms, others may be performing well, creating balance. This stability makes it easier to stay disciplined and avoid reactive decisions. Investors who lack diversification experience sharper emotional swings, increasing the likelihood of buying high and selling low. A balanced portfolio supports calm thinking, which is often the greatest advantage of all. Diversification also allows for rebalancing, a disciplined process of adjusting allocations as markets move. When an asset rises significantly, it naturally becomes a larger portion of the portfolio. Rebalancing involves trimming what has performed well and adding to what has lagged. This enforces a buy low, sell high behavior without relying on predictions. Gold and silver often benefit from this process as they tend to shine after periods of neglect. Importantly, diversification is not static. It evolves as conditions change. Age, income stability, goals, and risk tolerance all influence how a portfolio should be structured. Gold and silver may play a larger role during periods of monetary expansion and rising inflation, risk, and a smaller role during stable growth. Understanding this dynamic nature prevents rigid thinking and encourages adaptability. In times of major economic transition, wealth is rarely destroyed randomly. It is often destroyed through concentration, leverage, and inflexibility. Diversification counters all three. By spreading exposure, limiting dependency on any single outcome, and maintaining flexibility, investors position themselves to endure uncertainty. Gold and silver are valuable tools, but they are most effective when used in harmony with other assets. Those who embrace diversification are not trying to predict the future perfectly. They are preparing for a range of futures. That preparation, more than any single asset choice, is what protects wealth when the world changes. Periods of major economic, monetary, and geopolitical change are not just times of uncertainty. They are moments when wealth is quietly and systematically transferred. History shows that during these transitions, money does not disappear. It moves, it flows away from those who react emotionally and toward those who remain disciplined, informed, and independent in their thinking. Understanding this dynamic is essential to avoiding losses and positioning for long-term stability. Most investors are conditioned to follow the crowd. They seek comfort in consensus, assuming that many people believe the same thing. It must be true. In markets, this instinct is often punished. By the time an idea becomes widely accepted, prices have usually adjusted to reflect it. Late participation increases risk while reducing potential reward. When conditions shift, the crowd panics together, selling at the worst possible moments. This collective behavior is one of the primary mechanisms through which wealth transfer occurs. Independent thinkers approach markets differently. They study history, analyze incentives, and focus on probabilities rather than predictions. Instead of asking what is popular, they ask what is priced in. They understand that markets move ahead of news, not because of it. This perspective allows them to act when opportunities are uncomfortable and refrain when excitement is high. It is not about being contrarian for its own sake, but about being rational when others are emotional. Discipline is what allows independent thinking to translate into results. Discipline means having a plan and sticking to it even when emotions run high. It involves setting allocation limits, managing risk, and accepting short-term discomfort for long-term benefit. Gold and silver investors who lack discipline often abandon their positions just before conditions turn favorable. Those who remain disciplined understand that volatility is the cost of protection, not a sign of failure. Major transitions test patience, monetary policy shifts, currency devaluations, and geopolitical tensions do not resolve neatly or quickly. They unfold in phases, often with false starts and reversals. Investors who expect immediate outcomes grow frustrated and lose conviction. This impatience benefits disciplined participants who are willing to wait. Time becomes an ally for those who understand the cycles and an enemy for those who demand instant validation. Staying calm during panic is perhaps the greatest advantage an investor can have. When fear dominates, asset prices disconnect from long-term value. Decisions made in these moments are rarely rational. Those who have prepared mentally and structurally through diversification, proper sizing, and realistic expectations are able to observe rather than react. This composure allows them to either hold their positions or selectively add exposure when risk is being mispriced. Independence also means resisting extreme narratives. During times of stress, predictions become polarized. Some forecast total collapse, while others deny any problem at all. Both extremes are emotionally appealing because they offer certainty. Reality, however, is usually more complex. Independent thinkers remain flexible, adjusting their views as new information emerges. Adaptability prevents them from becoming trapped by rigid beliefs. Wealth transfers are rare, obvious, in real time. They are recognized only in hindsight after positions have been exited, assets repriced, and narratives rewritten. Those who lose often feel unlucky, blaming external forces or manipulation. Those who gain usually appear patient rather than brilliant. Their advantage lies not in secret information, but in behavior. Gold and silver, like all assets, reflect this process. They reward those who understand why they own them and penalize those who chase them emotionally. Investors who remain calm when prices are weak and cautious when prices are euphoric position themselves on the right side of the transfer. In the end, the greatest risk is not market volatility, inflation, or policy changes. It is losing emotional control and abandoning discipline. Those who think independently, respect history, and stay patient do not need to predict the future perfectly. They simply need to avoid the mistakes most people make. That alone is enough to ensure they are not among the 99.9% who lose, but among the few who endure and emerge stronger.